let's get Geoff Dennis in to help us break that down. Geoff, great to speak with you, and thank you so much. You know, even as we've all watched and rewatched that clip of Trump and Zelensky in the White House, my question to you is, what is the kind of impact this is going to have on the hope that the war between Ukraine and Russia ends soon?
I think it's very hard to say. I say this all the time about geopolitics, especially to do with this war. It's really, really hard to call. It was an extraordinary exchange and quite unprecedented. And I think Zelensky did a pretty good job keeping calm, frankly. I think where we go from here probably is eventually there'll be a deal between Ukraine and the US on these rare earth metals that the US wants to at least have some access to. But I don't see anything coming out of this argument in the White House that is necessarily going to bring forward a ceasefire. You've got to get Zelensky in the same room as Putin. You've also got to see how the Europeans are going to act and how much security guarantees they're going to provide. So it was a nasty spat, but I'm not sure it gives us a lot of clarity at all about how or when this war will end.
The other focus, of course, beyond geopolitics is US growth. In the latest data points suggesting that as early as the first quarter of this year, it's not going to look like a very pretty picture. What does that mean for equity markets, not just in the US, but for the rest of the world?
Well, we saw it last week, of course, with equity markets being very soft indeed. I am now getting quite worried about the state of the US economy. You have probably seen the well-known Federal Reserve Bank of Atlanta so-called nowcast model, which is calling at this point for a minus 1.5% annualized GDP number for the first quarter. So I think we may very well be looking at a negative first quarter. I think what's interesting about the data is that most of the weakness so far has been more in the soft data, the sentiment data, particularly consumer. The ISM services index was very weak, although you also got weak retail sales in January and a very soft unemployment claims data point last week. So it's going to be very important to see what the payrolls number are like this week. Now, I think what the market is doing, markets are smarter than all of us. They're getting ahead of this. And I think this big drop you've had in these equity markets in the past week in particular is really reflecting, above all, in my opinion, above all, nothing to do with geopolitics, nothing to do with Gaza or Ukraine, entirely, in my view, major worries now developing about the US economy, because economic actors, and particularly corporates, do not like uncertainty. And you've got uncertainty over tariffs, you've got uncertainty over taxes, let alone the geopolitics. And so I think you need some clarification how soft this economy is going to be before you start to see any sort of significant stabilization or rally in these markets. EM, by the way, last week, emerging markets were down 4.4% in dollars.
Geoff, good evening to you, Neeraj here. Been a really long time that we've spoken, so good talking to you. Would love to know how you think about the implications of the Chinese annual meeting in light of the fact that you're getting worried about US growth. And if US growth becomes a worry, if it brings rate cuts, etc., then money might move to EMs in general, which hasn't happened thus far. But also the fact that if China in this annual meet supports growth to the hilt, does it mean more money flows into China as we've seen in the last 3-4 months, or rather 2-3 months? And parallel to that, India has seen massive outflows over the last 5 months. You in your past role have looked at this very, very closely. When does this end? It's been, what, for $38 billion worth of outflows in the last 5 months from India.
A lot of questions there, if I may say so. I have a lot of skepticism about whether China is going to throw the kitchen sink at the economy with dramatic easing of policy, because they've not done that so far. They keep talking about it. I believe the big rally in China is because of positioning. I think it's because the market was cheap. It's still cheap, to be fair. And also a couple of important events. First of all, the new China AI model, which caught everybody out a couple of weeks ago. and also suddenly this meeting between Xi Jinping and some of these key business leaders, all of that created the impression, I think, that Chinese business leaders were getting back into the game, if you like. Now, this could go on for a while, but at the end of the day, the reason I'm very skeptical about China is because essentially you've got to get this economy going. You've got the property sector, you've got the lack of consumer spending growth, you don't have enough fiscal expansion to support the consumer. So I think the fundamentals still, to me, don't look great. Actually, what's very interesting, as of Friday night, EM's up 2% on the year, but if you take China out, EM's down 2% on the year. So the whole thing this year, if you like, is based on China. Now, where does India look like this? I'm not going to say anything different. I think the Indian fundamentals look far better than the Chinese fundamentals. I get it that you've had a lot of these outflows, and they may go on for a while. I think this is temptation amongst EM investors to compare India on the one hand with China on the other. Skeptical long-term about China, whatever it does in the short term. I still like the long-term India story, particularly because of the growth of the economy. And I think the scope down the road for the RBI to cut interest rates further.